It is hard to find a media outlet that doesn't talk about the recession lately. We've all seen the titles. At first, the government, the Treasury, and the Fed were denying that the US could go into a recession at all. To calm everyone down, we've heard statements about transitory and temporary inflation.
Economists call all these things transitory effects.
We were told that a recession was improbable.
I don't see signs of a recession in this economy at this point.
And of course, everyone ensured that the economic situation was stable.
The U.S. economy is very strong, performing very well.
But when confronted, the Fed wasn't that sure about their statements anymore.
So I think the word transitory has different meanings to different people.
Looking back, you clearly see that most of us, not Wall Street or the government, but the average citizen, realize that a recession is unavoidable only when the country is already in one. We don't notice that before simply because most media and the government assure us that everything is stable and there's nothing to worry about. Only when everything collapses, they have no other option than to acknowledge that the situation isn't as good as they said. The crisis of 2008 is a perfect example. The conclusion we can make out of this is that no one will care about your well-being and financial stability unless you do. That's why we're making videos like these to help people like you to be prepared for any economic turmoil. The Federal Reserve's responsibilities are confusing for an average American, even though we constantly hear about the Fed in the news. That's why several conspiracy theories appear over the years. Some believe that a secret group of bankers control the Fed to manipulate the global economy. Others say that the Fed deliberately causes economic recession to benefit the wealthy or adjust interest rates to suppress economic growth and benefit the government. What do you think? Let me know down in the comments. Look at how interest rates change over the years. At the end of 2008, they dropped to nearly 0%. And it continued like that for many years. And then, of course, the pandemic joined the game, resulting in another wave of record stimulus. So we have this chart right here, and it contains historical data of the housing market. And it was pulled all the way from 2000 to 2021, and the data was actually provided by Zillow. And what I want to do is to take this information and help you analyze a couple of key historical days, particularly the one related to the financial crisis in 2008, right? Why am I picking 2008? Because it was relatively the most recent one prior to the pandemic, of course. And that length of time will give us something more to grasp on and something more to analyze, okay? So what we're gonna do first is to take a look at the peak of the prices, because the peak of the housing market did happen prior to 2008. So when we look at the data from 2007, we can see here that the average house price over here in 2007 was somewhere around $217,000, right? So keep that number in mind. And at that point, a lot of people were complaining that the housing market was too expensive. There were a lot of people entering the market, getting access to reckless loans and stuff like that. But it was still a complaint that houses were still relatively expensive, right? So, be careful what you wish for, because the market correction did come in. And that's when we started seeing the housing prices go down in 2008. In fact, we went from an average of $217,000 for a house all the way down to, let's just pick June here, June 2008, just to find like mid-year, all the way down to $202,000. But for simplicity purposes, let's just round that up to $203,000, right? So what most people would have done at this point is to panic, right? And this is something I still remember vividly experiencing. A lot of people were panicking. You're crazy. Why are you even going into the real estate market? It's not worth it. Houses are losing value, yada, yada. But you know what? Some people did not let that noise or let that fear take over them. Were they afraid? I'm sure they were. But if you run the numbers right And if you know that your calculations are correct, you as the intelligent investor would have made the move of going into that market and purchasing that property where those prices were actually going down, right? But the drama doesn't end there, right? Because there's always something, there's always a crisis, there's always something worse that could wind up happening. And the shift downwards continued to happen all the way down to 2011, when the average price of a property was somewhere around $167,000, right? Let's just round that up for simplicity purposes. At this point, people are still panicking. This is crazy. Why would you buy? Houses are still dropping. And maybe if I wait a little bit more, the houses are going to be cheaper, right? But the intelligent investor does not do that. They don't take advice from people who don't know what they're talking about, who are just basically given into fear. What they do is that, once again, they run the calculations, they run the numbers, and they make an informed decision based on the numbers that they're looking at. They don't let the emotions take control over them. Are they afraid? Of course they are, but they're making an informed decision and they're going in, right? And guess what happened after that? The market started taking off. So whoever stood there in 2011 waiting for the prices to continue to go down, what happens? They wind up not buying anything because they already realized that, the houses are more expensive. But because they already went through this whole psychological pattern in 2007 and 8, they have hopes that the market will eventually fall again. And maybe that will be the opportunity for them to go in and buy. And guess what happens according to this data? That never happened. It did not go down. In fact, after 2011, property prices started going all the way up, all the way until the beginning of the pandemic in 2020. So the pandemic was a relatively recent event, and I'm sure a lot of us remember the drama, the fear, the news, and all the ugly stuff that was basically being bombarded at us, whether we will consume information in YouTube or whether we will consume it in TV, it doesn't matter. The point is that everyone was competing for eyeballs, and none of that information that was fed to us was positive by any way or by any means. All we were consuming at the time was fear. And I want to make something clear here. There's nothing wrong with being afraid. In fact, being afraid is actually a good thing because it's what keeps you grounded, is what keeps you in check. Imagine if you were fearless, you'd be doing dumb stuff left and right, without even thinking about the consequences. But because you have the ability, or we all have the ability to feel fear, we consider the risk. We stop and think, okay, is this the right thing? Is this the wrong thing? Am I doing something right? And if you're afraid of a certain risk to happen, you look for ways to mitigate that risk. You look for ways to prevent that from happening, or to find some type of solution in the event that that happens. But when you are paralyzed by fear, you're not going to go anywhere. And this is what happens with most people. Everyone was heavily consumed by fear in 2020 at the start of the pandemic, and they decided to do nothing, right? And rumor has it, don't buy a house, don't buy any properties, because the crisis is here, the pandemic is here, the stock market is falling. Mind you that the stock market is extremely volatile, and the real estate market is not the same. The real estate market moves a lot more slower than the stock market. There's a reason for it, because nobody can just increase and drop rent overnight, because no one has the ability to pay for a rent that has increased overnight. No family in the world is going to be able to afford something like that. And therefore, the rental market and real estate in general moves a lot slower. This is how the median house prices in the US change over the years. According to the Census Bureau, in the third quarter of 2022, the median price of a sold house reached the historical peak of $468,000. The crazy thing is that only 10 years ago, you could buy 2 homes for the same amount of money. However, if we check the real median household income, its growth isn't that fast. In the last 10 years, the median household income saw an increase of only 17%, barely reaching $71,000. By the way, We're comparing the median values because in this case, they depict a more accurate picture than the average values. This is because the sales prices of some properties are considered extreme values and don't necessarily reflect the average situation. Having said that, let's go back to housing prices. Why did the value of real estate increase that much and that fast? Well, several factors influence property prices, such as area popularity, for example. When more people are moving to specific regions, the prices go up because the land is limited, which is particularly true for urban areas. Sometimes the popularity can also grow because of the news. For example, when Elon Musk started building a new gigafactory in Travis County, Texas, home prices in the area went up almost 54%. The next factor that influences property value is inflation. It makes the cost of all goods and services rise, and real estate is no exception. That's why properties can gain in price over time without any value-added changes. Economic growth also influences pricing. When the economy is growing, people tend to have higher incomes, and as a result, the demand for housing increases, which drives property value up. Next come the interest rates. When they're low, borrowing money is easier, so buying real estate becomes more attractive. And another price influencing component is supply and demand. When the demand is higher than the supply, prices go up and vice versa. A great example of this will be California. According to the California Association of Realtors, in the third quarter of 2022, the state's median home prices was almost $830,000. It is twice as much as the typical US home price. Here, it's what high demand and low supply can do to a market. But of course, there is high demand not only for buying properties, but also for renting them. Anywhere from 50 to 60% of Americans say that they either don't want to purchase a property at all or that they can't afford it just yet. So the renting business, it's also flourishing. According to the IRS, 10.6 million Americans earn income from rental properties. The average landlord owns 2 to 3 properties, but it's worth mentioning that 40% of owners have their real estate value below $200,000, while only 7% own properties worth $1 million or more. Many believe that corporations hold most rental properties. Why are corporations even involved in all of this? The answer is obvious. Because of the money. One of the biggest trends in the US housing market right now is Wall Street firms buying up as many family homes as they can. These are not just individual investors looking for a side income. These big corporations have billions of dollars to spend and sophisticated strategies to earn even more.
There's about 25 to 35% of the houses in this neighborhood are owned by Wall Street landlords.
Corporations use technology, data, and low-cost financing to buy and manage thousands of homes across the country. But why are they doing this? There are plenty of other real estate types of investments: office buildings, hotels, and shopping malls. Why are they even investing in single-family homes? Well, there are several reasons for that. The first one is high rental income. Single-family homes can generate higher incomes than apartments and other residential properties. Houses generally seem more appealing to the average American, and obviously, they have more space and privacy, so people are willing to pay more for them. The average annual rent for single-family houses was $19,200 in 2020, compared to $14,400 for apartments. But both saw a dramatic increase of almost 20% in 2 years. Okay, sounds good, but what else makes single-family homes more appealing? Stability, because of the low vacancy rates. In other words, these type of rentals attract more stable and long-term tenants. Another reason single-family homes are always in high demand is their strong appreciation potential. Single-family homes go up in value more than any other asset. Another factor why corporations invest in single-family homes is to diversify their portfolio. And as we've seen, this type of real estate is a stable and profitable investment that gains value over time. Another serious reason why the growth of corporate landlords is ringing alarms is a limited supply of new homes. The US has been facing a chronic shortage of new housing for years. In the 1970s, the average number of new entry-level homes constructed was over 418,000, And in 2020, this number dropped to 65,000.
The government has estimated that we are short about 4 million homes in this country.
This happened due to rising construction costs, labor shortages, land scarcity, zoning restrictions, and environmental regulations. The pandemic only made things worse as lockdowns disrupted supply chain and increased demand for materials. As a result, the inventory of new homes for sale fell to a record low. This means there are not enough new homes to meet the demand from buyers, especially in fast-growing markets where population and income growth are strong. While the supply is low, the demand for single-family homes is rising, especially after the pandemic when many people realized that they needed more space than their apartments. Many also switched to remote work, allowing them to move outside of cities and even to other states. These factors created a perfect foundation for Wall Street firms and institutional investors to enter the single-family rental market. They have virtually unlimited capital, allowing them to outbid and outcompete individual buyers and small landlords. They can also pay all cash straight away. This gives them an unfair advantage and drives up the prices and rent in the market. Besides, corporations use algorithm and AI to analyze market trends, identify undervalued properties, optimize rent, and minimizing vacancies. Most likely, you haven't heard about most of these corporations. They act in silent and simply do their job. Who stands behind what we call corporate landlords then? Well, the world's largest private equity firm is Blackstone Group. It is one of the pioneers and leaders in the single-family rental industry. It launched Invitation Homes in 2012 to buy foreclosed homes after the financial crisis and turn them into rentals. Now, Invitation Homes owns over 80,000 single-family rental properties. The second largest single-family homeowner is American Homes for Rent, with about 50,000 properties. Another rental company out of Canada is Tricon Residential. It owns over 36,000 homes. Banks also get into the single-family housing to secure their finances. For example, JP Morgan, one of the largest US banks, announced investing up to $1 billion to develop built-to-rent homes nationwide. To make this possible, JP Morgan entered a joint venture agreement with Haven Realty Capital. According to Congressional Research Service, individuals own 70% of rental properties and around 38% of rental units. LLPs, LPs, LLCs, they possess around 15% of rental properties and 40% of rental units. While real estate investment trusts, REITs, together with real estate corporations, hold only 1.2% of rental properties and 4.3% of rental units. It is worth mentioning that LLPs, LPs, or LLCs may be both individual owners and institutional investors. So the actual share of rental properties and units in hands of corporations may vary. From individuals to giant corporations, we can see that real estate is in demand for different types of investors. But what is the reason for its popularity? One of the common reasons is safety, and the words of Franklin Roosevelt may reflect the opinion of many real estate investors. Real estate cannot be lost or stolen, nor it can be carried away. Purchased with common sense, pay for it in full, and manage with reasonable care, it is about the safest investment in the world. Is it the safest investment though? Technically speaking, the US Treasury bonds are the safest investments of all because the American government has never defaulted on its debt. Then, any list of low-risk investments will include gold, high-yield savings account, certificates of deposit, CDs, Series 1 saving bonds, corporate bonds, and of course, real estate. But its safety highly depends on the local conditions and the selected investment strategy. Let's dive deeper into both pros and cons of real estate investments. There are several reasons why investors see real estate as a good asset. First, is appreciation. Historically, real estate increased in value over the long term. This appreciation can lead to significant capital gains when investors purchase property at a low price and sell it for a higher price later on. Another benefit is cash flow. Real estate can generate rental income, which might mean a steady stream of cash flow for investors. That's why real estate is one of the most popular sources of passive income. Tax benefits. Deductions for mortgage interest, property taxes, and depreciation can all reduce the overall cost of owning and maintaining a property. Another possible advantage could be inflation hedge. You see, When the cost of living goes up because of inflation, property values increase, which is a good thing if you're a property owner. Additionally, real estate is much less volatile compared to most investments. Its worth tends to remain stable even during economic downturns. And last but not least, real estate is a tangible asset that investors can see and touch. By being less abstract than stocks and bonds, real estate is often more attractive to some investors. But what is the downside of real estate investment? First of all, high upfront costs. Down payments, closing costs, and other fees make it more difficult to enter the real estate market than, let's say, investing in the stock market. The good news is that there are programs out there that can help you access real estate with as little as 3% down. And in this video, I'll tell you all about it. Feel free to check it out after you're done with this one, of course. Another possible vulnerability is market fluctuation. Even though real estate might be less volatile than other investments, it still responds to market changes. For example, after the crisis of 2008, real estate saw a 27% decline in value. One of the biggest downsides of owning rental property is maintenance and repair costs. It might not only be expensive, but also time-consuming. And unless you have a property manager, your real estate business can't fully be passive because you will still have to take care of the place. Another issue worth mentioning is liquidity. Compared to other investments, real estate is typically less liquid, which means that it can be more difficult to sell a property quickly if needed. If you only rely on real estate investments, you might be less flexible and less agile in responding to changes in market conditions. Overall, the housing market in the United States experienced many ups and downs over the years, influenced by economic conditions, demographic shifts, and technological advancements. But still, all that didn't make real estate investment less popular or profitable over the long term. And the truth is that the general rule of thumb for investing is to have a long-term strategy and diversify your investments, no matter what the assets are. Real estate can be a great addition to your portfolio if you know how to evaluate your deals. And if you are in the search to learn how to invest in real estate the right way, feel free to join this free webinar. See you in the webinar. Bye-bye.